there's a much longer period for the Section 83B as there is for the Section 431. So the limit for the Section 83B is 30 days.
Wow, that's not long.
It's not long, but the limit for Section 431 is 14 days.
Wow, Michael, that's not long.
That's not long. And so the issue here is often people will come, particularly when they've been given an award by a US employer, and say, oh, I've been given this Section, A3B election to sign. Is it a good idea? And we look at it and go, well, when were you told about this? They are 2 weeks ago. When was the legal award made? Because you may have 1 day or 2 days left to do the equivalent UK election if we decide that's the right thing to do. That is one of the big red flags. If anyone mentions an election, get advice immediately.
Welcome to the US-UK Tax Talk podcast. In today's episode, we're going to look at what happens when employees have complex remuneration structures and are being paid in shares, for example, rather than just cash. Fortunately, I'm joined today by Michael Lewis, a partner in the US-UK cross-border private client team at EY. Michael's been doing this for almost 3 decades, and so he's a really, really good person on to have talking about this topic. We hope you enjoy the episode. Michael, hi, good afternoon. How are you?
I'm very good, thank you. Very much enjoying the air conditioning.
Yes.
We'll experience a heat wave outside, so it's nice to be here with you today.
We're hoping the only thing hotter than the temperature outside is the chat we're going to have today. I think I might have used that joke before. So you have come to us today to talk about an area that I've wanted to do for quite a long time, which is thinking about the ways in which high net worth employees often get remunerated in more than just a regular salary, like a lot of people see. Something I think is particularly common with American employers, and something that therefore means we've got to think about both US and UK taxation.
Absolutely. There are a few issues which need to be considered. I should add that this is a very highly complex area, where we do indeed have a specialist team led by my colleague Stephen McAndrew, who actually specialise in some of the real knotty issues. But, we'll cover the generalities today, which people get a taste, I hope, of what they should consider.
Yeah. And I come to this as much at your feet, learning to understand as everyone else, because as lawyers, we don't tend to get as much involved in either negotiations, unless we're employment lawyers and we're negotiating broader employment packages. But the pure arch income tax that this so often is, I'm here to learn as much as everyone else, Michael.
And it's worth saying, as an accountant, sometimes we get the information at the wrong end. It's when we're doing the tax return, and you're like, what we want to do is raise awareness so that clients will communicate with us and with lawyers and other professionals at the beginning of the process when they start being awarded compensation, or they're thinking of they're having a taxation event, and not just months later when it comes time to file their tax return.
As an alumnus of this show, and someone I know well said to me once, it's better to prepare than repair. Mm-hmm. So when we think usually about employees and how they're paid in the UK, we think of PAYE. We think of tax being deducted at source and not having to do a tax return, and it's all quite straightforward. Talk to me about why, before we even get into topics like deferred compensation, why simply being an American at its fundamental core throws up complexities when you're working out of the UK.
Well, immediately as an American, it's, as I think everyone knows or should know, they're taxed on worldwide income regardless of where they live. So an American is always going to be taxed on their remuneration they receive in the UK. So the first issue is, are they going to get a full offset for foreign tax credit purposes? Mm-hmm. And fortunately, for most compensation, there isn't a problem. Most compensation, particularly if it's paid in cash, the timing of recognition event will be the same or similar. So the US uses the term of constructive receipt to determine when something is taxed. The UK uses the earliest of receipt or entitlement, and that basically comes to the same date in 99.9% of times. The other good thing is that most remuneration has PAYE attached to it, which means that so long as they're on the paid basis of claiming foreign tax credits, Americans can get a foreign tax credit. So often for cash remuneration, very simple arrangements, we don't have a problem. It's
relatively speaking.
Yes, but when you deviate from that, so if someone's not on the paid basis, or indeed if there isn't PAYE, or there's elections involved, or there's some quirky situation, and we'll come into this, especially for deferred compensation, then we start having some complexities, which can result either in potential double tax risks, or indeed could result in a penalty charge.
And I think something you were saying to me before we started recording, which I want to make sure you have the chance to echo whilst we are recording, is that in your practice, you will often see this at the back end when the tax return information is being collated. You would rather that information came to you slightly earlier so that you had a chance to be involved in the discussions.
Absolutely. So we want to be there when the plan is being, designed, hopefully, or at least the award is being given. Sometimes there's a choice. We've seen employers have US and UK awards, and they've automatically given someone the US award when the UK award would be better, and indeed vice versa. And so sometimes there is a choice, or indeed we can look at a plan and say that is so bad, you should refuse it and go back and negotiate for something better.
And I guess context being important here, we're largely talking from the employee side here.
Absolutely.
The American in the UK. They may be working for a small company, a small tech startup. They might be working for a very large tech company. These issues can be often the same, but your leverage might be quite different. And from your perspective, we're just focusing on the employee.
Exactly. As a private client professional, we typically advise the individual on their personal obligations. There is sometimes an overlap with the employer's obligation, and we may get pulled into those discussions as we try and educate the employer about taxes in the UK. But very often it's worth saying that for most employees here in the UK, because of the very strict PAYE rules, more often than not, PAYE will be due. And it's a very rare occurrence where the employer of record does not have a presence in the UK, which gives rise to a PAYE liability.
Is it the case that one of the reasons why it's more complicated in America is that the employer-employee relationship can often be a slightly more blurred one than the kind of straightforward PAYE remuneration here?
It can be, albeit often this will have been reconciled as part of a visa arrangement. But yes, the US contractual arrangements are much more limited. So they have, it might just be a one-pager, basically saying you're an employee with very little terms. Often people might be working as independent contractors, but when you look at it, you think, actually, they look so integrated, they're really employees.
I'm sure my employment colleagues here would want me to flash up saying, make sure you get UK employment advice on whether you are an employee and what your rights are. We're not an employment podcast, but I'm sure they would tell me I should be saying that.
And we get other complexities, particularly on the social security side for national insurance purposes, where I think we might come on to it later about totalization agreements, where who is the employer of records? Because it may, on paper, it may look to be one entity, but in substance, it may well be another. So those are all sort of things which need to be sort of taken into account.
And I guess the final sort of headline warning red flag for people, and maybe this is a question that doesn't have an obvious answer, is if I'm an employee in the UK, how do I know whether what I'm doing is sort of right for US or UK purposes? Like, my employer might be withholding tax in the right country. My employer in America might be trying to withhold tax. Like, beyond, obviously going to seek good advice, Michael, I appreciate the answer might just be there is no obvious set of parameters. But is there a rule of thumb that should flash up to someone saying something's probably not quite right here?
If PAYE is being withheld, that's a good comfort zone. So I'd say red flag is when PAYE is not being withheld. That should be a number one red flag. Second red flag is if anyone suggests any form of election, you should immediately think, if they suggest a UK election, you should immediately question, what about a US election? And vice versa. If someone mentions the US election, you just quickly question, but is there an equivalent UK election? Because those are where the big red flags come up, and those are the ones which can be easily recognized. There are other issues which are, I think, we'll come on to 409 Cafe, which are probably more complex and more difficult for the man on the Clapham omnibus to be able to spot. But I think those are the ones I mentioned, which I think are red flags, which should be
It's a good way of thinking about it, because in my own practice, I do this as well sometimes. When someone is truly with a foot in either camp, you say to them, does that thing that you're being presented with look really American in nature or really British focused in nature? If so, it's more likely that someone hasn't thought about the consequential treatment on the other side. You need to make sure that whatever's done in country A is reflected in country B. And if they haven't thought of that, that's when you need to go and see someone like Michael. So you were kind enough to tee me up to this concept of totalization agreements and paying national insurance in the UK and paying social security in the US. Conceptually, they can be quite similar, but given what an integral part of someone's employment relationship they have, I think it's quite misunderstood sometimes in the UK what people need to know when they're an American.
So, I think you mentioned about them being similar. The rates for the employee are indeed quite similar, but the rates for the employer are widely different. And on the basis that may feed into the ultimate package that an employee may be able to negotiate, or indeed it may indeed feed into P&L and other items on which the individual is judged. Individuals have an incentive to actually take into account the employer costs as well. So the basics is that there is agreement between the US and the UK on Social Security, known as the Totalization Agreement. It's designed to ensure that individuals are covered by Social Security at all times and are not penalized by working in one country or the other, for instance, by having a break in their Social Security record. And it does this in sort of two ways. One, by apportioning who has a right to Social Security, and two, ensuring that there's some kind of credit mechanism to allow you to qualify for Social Security in the other country, should, for instance, you not have quite enough years of coverage to be able to otherwise qualify.
Help this poor lawyer understand, is the situation in America like the UK, where in the UK I need, is it 35 years of national insurance contributions to qualify for the state pension? Presumably it's the similar quality needed in the US.
So, for instance, the minimum is 40 quarters in the US. So if you didn't have that, you wouldn't qualify for Medicare. So you can, let's say you've got some coverage in the US, you can get a pro rata share of the minimum by using your UK years of coverage.
And is that something I note or I claim on my tax return? Is it
a certificate that's provided? The Social Security is something highly complex, and indeed it's something you need to go and actually speak to a specialist Social Security expert to try and claim, to navigate this double relief. Hopefully you've got enough relief in both countries. And the good news is that until like a couple of years ago, the US used to have what's called a windfall tax, which stopped you claiming benefits, sort of double benefits. So you weren't allowed to claim a full US pension, state pension, and full UK pension without this double tax with special tax applying. And they actually abolished that. So in an ideal world, someone will have full number of years of coverage for US purposes and be able to claim a US pension, and have full number of years to be able to claim a UK state pension as well. And that now does happen.
What I heard from you there was, if Michael, with his nearly 30 years in this space, says you need to go and see a specialist, you definitely need to go and see a specialist. Let's move to the I think probably the largest area I suspect we're going to talk about today, which I know collectively is deferred compensation, but in my brain I think of as when I'm being remunerated for my job in something other than cash.
Well, I would just take a step back to say deferred remuneration isn't always non-cash.
Right.
It can be cash. And sometimes we see arrangements whereby individuals are awarded a bonus, but this bonus is then sort of put into escrow and it's invested on their behalf. And so ultimately it still pays out in cash, but it's still deferred. I would make a distinction to say deferred compensation is where the entitlement to the reward is separated from the receipt of the award.
It's deferred, you might say.
Exactly. So you have the right, but you don't have the money. And you are correct that in the vast majority of cases, the way that is engineered is through some form of non-cash arrangement, principally stock.
And to be clear, what we're not going to touch today, which is because it's a wholly different area of employment law, would be things like redundancy, retirement, unfair dismissal, any of those kind of awards that you might get.
Absolutely.
We are talking about remuneration in the course of your continuing employment.
Absolutely. All those raise significant issues, and indeed the US and the UK do have different tax rules, right? Particularly when it comes to issues such as damages.
Yes.
So we're not going to touch that because we don't have 5 hours.
Another topic. So when we enter this topic, and I find this sometimes when I have the opportunity to speak to people, Michael, in your position, I sometimes words flash up in front of my eyes because I know these are things that matter, but they're like jigsaw pieces on the table before they've been put together. And I see things like restricted stock units and ISOs and all of these different concepts that don't mean an awful lot to me other than knowing they sound complicated and I need to make sure I speak to someone like you. So can you kind of walk through the very general 1,000-foot encyclopedia of what we should be thinking about when we think about deferred compensation?
When we come to share remuneration, there's sort of 3 main types. There's the free shares, or perhaps the reduced price shares, where you're given shares or allowed to buy shares in your employer. And we call them generally restricted shares because they will come with restrictions, such as you may be forfeit if you leave within a certain period, or indeed you may have to sell back to your employer at cost if you leave within a certain period. And those are sort of restricted shares.
You're in effect being incentivized to continue to work hard for the company by being given the opportunity to become a shareholder in the company and therefore share in the profits of the company.
Exactly. And you are a shareholder. Yeah. And the shares may actually be held in escrow. You may not actually be the custodian of the shares, but you are the legal owner of record of those shares, right? Then we come to restricted stock units, which often people get confused.
Like me.
With restricted shares. This is really a promise to receive shares. So this is where the employer may say, if you do a good job, right, at the end of this period, you're still employed, we will give you X amount of shares. It's a promise to deliver shares. Mm-hmm. You're not actually a shareholder. It's a promise.
Is what you then receive restricted shares?
Well, often they are unrestricted shares.
Right.
You can get variations where then what you get is then restricted shares. I have seen that in practice.
Sure.
That adds another level of complexity. But more often than not, what you get are unrestricted shares, that you get these shares, and if it's a public company, you can go and sell the shares. If it's a private company, you have to wait until there's some events to realize your money. And then, of course, we get stock options. And that stock option is the right to buy a share, right? And at a certain price. And that price, may depend. It may be, the price is generally set at the market value on the date of award. But often, you might have, awards where there's a discount, where immediately you can see that you can make a profit by buying the shares at an undervalue, right? So, and those stock options then come in different sub-flavors. So the US has a flavor because they have what are called incentive stock options.
That's my ISOs.
Your ISOs, effectively otherwise known as approved stock options, while the UK has approved stock options under the CSOP arrangements, company share option plans, or indeed the EMI, Enterprise Management Incentives scheme. So there's sort of these sub aspects of the options cause a lot of confusion as well.
And I know we're not putting ourselves in the shoes of the employers, but let's just say imagine for a second we were putting ourselves in the shoes of the employers. Why might I want to award one thing rather than the other? Why, as an employee, might I want one thing rather than the other? It may be obvious once we sort of talk it through, but if I'm a lay person coming into this sort of opportunity for the first time, which of these are the things I'm going to be looking for most?
Well, if your employer, often this stock is great because it doesn't cost you any cash, particularly if you're a startup enterprise, right? But yet you can use this to really incentivize the individual, especially if they've got strong hopes that the business is going to take off. As an individual, would you rather cash or stock? I guess you'd probably in most cases rather have cash because you can buy the stock if you really want it. Albeit, if this is an extra on top, I think it can be very attractive. And we do see individuals occasionally make a lot of money out of their stock awards.
At a high level, before we get into some of the complexity, why is there a disconnect or a complexity in the US-UK tax world with these kind of systems?
So there's almost sort of three sets of rules. One, the US and UK do not recognise the approved schemes in each of the countries. Two, there are elections which need to be made, which are also not recognised automatically in each other country. So you need to make sure if there is an election, you consider the other country. And you need to manage the sort of foreign tax credit position as well. If, for instance, some of these awards don't have PAYE applied, are you going to have foreign tax credits to cover that position if there isn't, for instance, PAYE?
I mean, you said a couple of minutes ago that it could be the case sometimes when your advice to a client hypothetically might be it's not even worth you having some of these because you probably end up in a worse position.
Well, I should have said actually the fourth one is the issue of the US anti-deferral regime known as 409 Cap A. And I think that's probably what I was referring to when I said that, Aidan, because that's the one where you can get a penalty for certain awards. And if I thought I saw an award which I thought was wholly within 409 Cap A, I almost probably would say to an employee, don't accept.
Yeah. So you've used the word elections a few times now. So let's think about these elections because they really are quite important for the purpose of these types of shares. I know there's a 431 UK election, and I know that you're going to tell me about the equivalent in the US. Talk me and the listeners through what these elections do, why you need to make these elections, why the timing of them is important, and where that mismatch happens in the US and UK.
So these elections, well, I'll start with the Section 431 election. It's an election you make when you're given an employment-related security. And we don't have to make it. But what it does is it brings forward the tax charge so that the income tax charge is fully and wholly only at the time of award.
Right.
So that's the election, which says, please tax me to income tax now. Bring into value whatever I've been given.
As opposed to
perhaps later when the restrictions lapse.
Right.
Now, this is almost like a bet because you might do this where you think the value of the shares is going to go up. So rather than tax me on the value in the future, which is going to be a higher value, I'd rather pay income tax now at the lower value. And indeed, if the share price goes up and I sell the shares, the difference between what I've paid tax on now and what I, ultimately realize in the future, I'll pay capital gains tax.
At a lower rate.
At a lower rate. Of course, capital gains tax is 24%, income tax is potentially 45%. So you can see why someone who thinks the price is going to go up might be inclined to make this election. Of course, shares can go down in price. So there is always a risk with these things. But that's why generally people do it.
Sorry to ask the obvious question, which occurs to me, but if the price was going to go down, I've just answered my own question in my head. If the price goes down, then at the point of the restriction lapsing, the price being lower, you're paying less tax on either scenario. So it would have been better to have not made the election if you thought the price was going to go down. I'm learning. This is for the first time. Thank you. And what about the US version?
Well, the US has its own version, known as the Section 83B election. In principle, it does the same thing. You elect to pay tax up front so that you can get capital gains tax on the appreciation. There are differences between these two elections. So let me quickly run through it. So the Section 431 only relates to employment-related securities. The Section 83B is a wider election. It applies to whenever you're given any form of property by your employer, which can include shares, but is a wider class.
What might you have that's not shares from your employer?
Anything, right? An object,
a
piece of art, right? Something which is non-cash,
but that might grow in value.
Exactly.
Right. Okay.
Right. So it's a wider definition.
I'll bear that in mind next time my employer offers me artwork.
Yeah. The Section 431 election is a jointly signed election. The employer and the employee have to sign it, but it isn't filed with HMRC. The US election, Section 83B, is an election just by the individual. It is filed with the IRS with a copy given to the employer.
Sorry, this is basically a silly question now. What's the point in having an election co-signed by both parties if it's not submitted to HMRC? Is it just go on your self-assessment return that you acknowledge you've done it?
Well, there is employers should do a share schemes report.
Right.
And on that share schemes report, due, I think, 6th of July after the end of the tax year, they should include this with a box ticked to say a Section 431 election is done. But there's no proof which is provided unless, of course, there is a tax inquiry, and then HMRC will ask, can we see this thing?
Right. So it's an employer problem, not an employee problem, in effect.
Yeah.
And in your experience, getting a US employer to co-sign a Section 431 election doable?
It's eminently doable because, as I explained at the beginning, in most cases, they will be a PAYE liability. So they will have had to get their heads around having liability to UK taxes, in which case...
This is nothing.
This is a nothing. And especially if they are aware of the Section 83B election, then they're aware that the employee can put obligations onto them. And here, in many ways, the UK is better because, an employee can't put an obligation onto an employer that the employer is not willing to accept.
I know enough about this area to know that timing is quite important. You might even mention it previously. What are the timing issues on these elections, and why does that cause problems?
And this causes a lot of problems because there's a much longer period for the Section 83B as there is for the Section 431. So the limit for the Section 83B is 30 days.
Wow, that's not long.
It's not long, but the limit for Section 431 is 14 days.
Wow, Michael, that's not long.
That's not long. And so the issue here is, often people will come, particularly when they've been given an award by a US employer, and say, "Oh, I've been given this Section, A3B election to sign. Is it a good idea?" And we look at it and go, "Well, when were you told about this?" They are 2 weeks ago, and it's like, well, when was the legal award made? Because you may have 1 day or 2 days left to do the equivalent UK election if we decide that's the right thing to do. So, you do need to be on the ball, which is why right at the very beginning of this podcast, I did say that is one of the big red flags. If anyone mentions an election, get advice immediately.
That is a staggeringly short window within which an employee is supposed to be able to get their affairs in order.
Well, one hopes that the employer has been discussing it with them before the actual official award date. So you might, employers who do it well will provide sort of documentation and discussion, and papers, a month before to say we're coming into the award window. You will receive the following awards. This is what's going to happen. So it's not a big surprise.
Fine. Okay.
And you can sign them in anticipation of an award, so you have it.
Right. Okay. I feel better now for those people that have to do this. I was worried that you had all these poor employees having to run around, but as you point out, it's probably actually.
Although I should say another big difference I didn't mention is that Section 431 just has to detail the security. The Section 83B has to also include the valuation of that award.
Which is presumably not a complicated valuation to make if it's on public securities?
If it's public securities, not a problem. But it is an issue if they're not public. Right?
Which is, of course, half of the reason for doing it if you're trying to incentivize.
Especially for a startup company.
Should you always be doing both elections? Are there times when you don't want to make both elections?
So this is an interesting one because in the world of US-UK tax planning, the number one thing that we are generally always trying to do is achieve an alignment between the US and the UK.
Tax harmonization.
Exactly. But there are scenarios where someone might get an advantage from not doing that. So, for instance, we do have cases where we might say, do not file the Section 83B, even though you might file the Section 431 election. And we do that as part of planning to save on the net investment income tax of 3.8%.
This is the Obamacare tax in America.
That's correct. And we do that in scenarios where the individual has more than sufficient, and we will model this out, project, and there are risks involved, foreign tax credits to cover the future appreciation. So if you imagine the share price today is, let's say, 100, let's say, they're optimistic, it might go to 500, right? So the individual pays UK tax on 100 now because they make the Section 431 election. They will pay US tax on 500 in the future, hypothetically. There'll be 400 of appreciation. That will be compensation. If they've got sufficient UK foreign tax credits to cover that appreciation, well, that will just cover the US tax and no more US tax will be due. If they make the US election, then that 400 increase will be subject to capital gains tax in the US, which might still be covered by foreign tax credits, but will also come with the Obama tax,
which is not creditable.
Not creditable.
I'm learning.
So you save on the 3.8%. But there's a risk here, and the risk might be, well, what if the price goes up to 1,000? And you don't have enough foreign tax credits? You've now got 900 extra subject to income tax in America, right? And you don't have the foreign tax credits, and to save a 3.8% tax, you've given yourself a 37% tax.
Probably not worth it.
Right. So it does have to be a bit of care, but, one can make prudent assumptions and do modeling based on how many excess credits someone's got. And often the taxpayer might be comfortable to say, actually, in any scenario, I can't foresee this being a bad idea. But I mention this only to say, although generally we would always do both elections together, this is an example where you might consider not doing it.
I feel like I'm about to ask a question like I'm a graduate at EY for the first time coming into the partner's office. Would that matter if I was moving to a high income tax state like New York or California, because you don't get to credit your state income taxes?
Well, that's another reason why.
Oh, thank God for that.
For instance, so another reason why you might do the election, right?
Yeah.
Is if you might go back to the States.
Yeah.
Exactly. Correct. You do not want to pick up a state liability.
And let's say probably California and New York have their fair disproportionate share of high-tech companies.
Although, when we talk about people going to states, you bring up the idea that actually there are times when even a non-US taxpayer may actually want to be doing a US tax election.
Yes, talk about that.
So, for instance, a non-American who might move into the US in the future may want to actually recognize a hypothetical US tax charge on grants when they are not actually subject to US tax, so that when they're in America, and perhaps when the default US tax charge arises, which is when restrictions lapse, when the award effectively becomes vested, that they don't then pay an income tax charge on that award. So often, again, which is a frustration when people come to us too late, but we might want to be meeting clients 3 or 4 years before they move to the States, because often these share awards have a 3 or 4, even sometimes 5-year vesting window. And we might be making US tax elections, on these awards multiple years before you actually go there.
How much success do you find in having people come to you 3, 4, 5 years before they move?
Never.
But it's a nice ideal scenario. And when people listen to this, Michael, they will, of course, all immediately come flooding in towards you.
I would say, though, no scenario, it's very rare for those elections to have a cost. There are scenarios when it can be negative to do the elections. Again, we'd be straying outside the remit of this podcast. But in 99% of cases, there's no cost to doing what we'd call a protective Section 83B. So if there's a slim chance of moving to the States, do the Section 83B. In fact, some employers just automatically give it to their employees alongside the Section 431.
Okay. Yeah. Now, you referred previously to 409A, and you said this is the area where we need to be very careful, because it might even be a scenario where you suggest that someone doesn't take the shares. So talk to me about what this problem is and why it comes up.
So
strap in.
This is the bogeyman, right? It really is. And so what is 409 capping? Well, it's described as an anti-deferral rule, albeit it's much wider than that. It's anti the ability to determine when taxation occurs.
Isn't that what the election does?
Yes, but let me explain.
Sure.
Because first off, Aidan, remuneration where you can make the election does not fall within the scope of 409 capping.
Right.
So I started off earlier saying that the Section 83B election applies to property. Mm-hmm. So now we're talking about awards which are not property.
Right.
So this would be cash awards, and it would include things such as restricted stock units, which are promised.
Right, I see what you mean.
So that's a non-cash award, even though it comes in the form of shares.
Yeah.
It's a promise. That's the award. Stock options are also fall within these rules, unless they meet certain special rules, which look at whether they have what's called a 409 cap A fair market value exercise price. Right? But property on which you can make Section 83B is excluded. And these rules apply whenever someone has is vested, they have a legal entitlement to an award, and the delivery date can be varied.
Fine.
If there's a fixed delivery date, we should be fine, right? But if the delivery date can be pushed back or it can be brought forward, we have a potential 409 Cap A problem. And this is a problem because there's a 20% surtax.
Mm-hmm. This is a US tax we're talking about.
A US tax. So
Fine.
I should say, this is the US anti-deferral mechanism. And so, common examples which that we, see would include employee benefit trusts, where someone has been given a vested entitlement within that trust. They've been said, this is yours. A bit similar to the UK earmarking concept. Discounted options, where someone has been given a stock option, but the price at which they can exercise it is set below the market value on the date of award. And we often see that when in the context of EMI options. So when someone says to me, it's great EMI options can be great, but often when they come with a discount, it causes a problem. We see them with restricted stock unit awards, because often these stock unit awards, they look on paper fine. When you look at a high level, you get the stock unit, only if you stay in employment and it gets delivered on this date. But then we look into the rules, and there might be generous good leaver provisions, which basically means that, well, you're really always going to get this. And then it might have rules where you can then pay out earlier if you're a good leaver. Well, that means that the delivery date can be different. So that can be pulled in. We see them payment in lieu of notice if it's more than 6 months. That's a problem. And we also see that for redundancy and severance pay of certain specified employees.
If I'm hearing you correctly, if I find myself potentially falling into one of those buckets, 409 Cap A is going to apply. It's not something I can negotiate out of beyond making sure my payment in lieu is less than 6 months.
Those are where we see the problem,
Sure.
right? For instance, right, the EBT, if we know in advance, well, we might change the terms so you're not actually vested in the EBT. You can still be a potential beneficiary of the EBT, but you don't have vesting rights. Discount options, well, we could, there was planning to do about whether, a separate plan for Americans, which doesn't include a discount. Payment in lieu of notice, maybe restrict that to just 6 months, right? Redundancy payment for certain specified employees. We can, that can be negotiated when someone leaves, so that falls within the 409 Cap A exceptions. So in almost all cases, we can fix the problem if we know about it at the beginning. What we can't do is fix the problem when we're presented with all the details to file someone's tax return, and this has already happened.
Feels like you probably want some good employment lawyers working with your US UK tax advisors to negotiate the best possible exit so that you don't get caught by these rules.
Yes.
If only we think about some people that could do that. Am I right, sort of tacking slightly, am I right that one of the areas these kind of stock payments may come up is when we have, I'm going to call a change of control. If my company's being bought out, if we're being bought out by private equity or doing a management buyout or any of these sorts of things, I might be awarded some shares in the new company, for example, or some interest in the new company. This presumably means I now have to think about these issues as the control hands over to my new employer.
Absolutely. So that's a classic scenario where remuneration issues happen at both ends. So that's often a 409 Cap A issue because there might indeed be there might be delivery terms that say that change of control triggers delivery.
Right.
But change of control under the 409 Cap A rules has a very narrow definition. So that is an example, for instance. So 409 Cap A allows you to change the delivery date in a number of limited circumstances. One is separation from service. Another is disability. The third is death. The fourth is as long as there's a specified date, and the fifth is change of control. All have very narrow definitions, except I think death. We're very clear what that means.
Yes, fairly understandable.
But the others have very narrow definitions. So you might think, oh, I have a change of control here. Well, do you really under the US definition of change of control? So once again, we need to sort of narrow down, look at those rules, because just the possibility that you could deliver without meeting the US rules is enough to make you liable. You don't actually have to have an event which fails if the paperwork will allow the possibility you have a problem.
I'm really looking forward to the prospect of a, UK tech company awarding these sort of schemes, and the American employee going to them and going, before you sign off on all the paperwork, can I just check? Can I be the grit in the wheel that says, actually, can I just check whether there's a change of control because I'm subjected to 409
Well, this is the thing. So what we would recommend for anyone receiving, deferred remuneration is that they ask maybe to see the award documentation, right? Or the prospectus. And if it has been looked at from a US perspective, it will say almost invariably the first paragraph is that this plan is being designed to be in accord with Section 409 Cap A. And it will probably have a second paragraph that says anything which is, in this document which appears contrary to Section 409A should be read in a manner which is possible to comply with Section 409 Cap A. And if it has those clauses, then you should breathe a huge sigh of relief to say that someone has looked at this and a lawyer has agreed that those paragraphs can go in, and someone has at least considered it. If it says nothing about 409 Cafe, be worried. And you should be waving this big red flag to your employer saying, I'm an American. Anything I receive needs to be looked at with this 409 Cafe lens on.
Fine. And just for what it's worth, as an aside, who in that scenario should that employee go to speak to? It should be to speak to specialist US tax counsel.
Yes, so tax counsel, this is a legal drafting, so we can give an opinion about whether there's 409 caveat issues, but as accountants, we wouldn't tell them how to redraft it. We would say, this is where if you've got a problem,
go back to your
lawyers. Right?
Michael, I've got the words 280G written down on my page here, and as a bit of inside baseball, I try always to think of a clever and erudite segue into the next topic, but I just don't know how to segue into this because I can't remember what it's about.
You have inadvertently segued into it in any case, because you just brought up change of control, and I was talking about change of control in the context of 409 Cap A. But change of control is absolutely at the heart of Section 280G. And this is another type of anti-avoidance legislation the US has. And what they're concerned about here is a misalignment between the interests of management and shareholders, particularly the potential for management to have insider knowledge of the true value of a company, which they don't share with shareholders. They encourage a change of control situation whereby they are then rewarded by the purchasers.
I can see where that exists.
In allowing the purchasers to acquire something highly valuable. So, for instance, a tech company which has some fantastic tech developments, in-house, which they hadn't been released yet, or something, right? That would be like the example. And in certain scenarios, if you fall foul of these rules, then the penalties are similar to 409 Cap A, a 20% surtax. Plus, the remuneration is non-corporate tax deductible for US purposes. So where this applies, first of all, we have to have a change of control, which has a specific definition. But it also doesn't apply to everybody. It applies to individuals who are disqualified. And this basically is the 1% shareholders who are also receiving remuneration. It includes officers of the company, so all the people on the boards or who represent themselves as officers, and also includes your sort of top highly paid individuals.
People who are most likely to have insider knowledge.
Exactly.
Right.
You then look at their earnings over the prior 5 years. You need to do an analysis. Say, what is our average earnings at this employer over the prior 5 years? And then you look at what earnings they're getting in relation to the change of control. And they might be triggering, award payouts. They might be given a special incentive arrangement to stay on as management. They might be triggering vesting terms. And so you look at all these things saying, what's the total remuneration that they are getting, right? And then you calculate this. And if they receive more than 3 times their average, there is a problem.
Right.
They are potentially in breach of Section 280G, right?
Yeah.
And if that's the case, then the excess is subject to this penalty charge,
which is
20% surtax.
Same surtax, right.
However, you can fix it. And you fix it generally by way of a shareholder vote.
Mm-hmm.
You present to the shareholders, who the selling shareholders, to say, just so that you know, all these people are going to receive X as part of the deal. And should the deal happen, do you approve? However, the shareholder vote also has to give the power to the shareholders to say, no, we don't approve,
sure,
such that they don't get it. So by putting them to the shareholder vote, you're also, the employees have to accept the risk that what they thought they might be getting could be taken away from them because if the shareholders deny it. It's effectively they're waiving those rights.
Yeah, so if this is all about protecting the value of the company, but if the shareholders go, that director, that officer is valuable enough to the company, we all agree that they should be paid that much, then fine.
It's eyes wide open. This person is being paid 100 times their average salary. Why is that? Let us investigate that a little bit more.
Maybe you're a South African living in California, running a large electric vehicle company, and you're being paid billions of dollars as a bonus for your work. Maybe your shareholders think that's an acceptable thing for you to be paid.
Yeah,
that's for them to decide.
So it's up to them. It's eyes wide open. If they approve it, great. If they don't approve it, then there's a risk to the employee. In some cases, there's a lot of admin involved in shareholder vote. So in some cases, what you might do instead is, let's say we've done the calculations, both for the average earnings of the prior 5 years and what someone's getting on a change of control. And let's say it turns out to be 3.1 times earnings.
Yeah.
You might just say to them, let's just change the award slightly so it becomes 2.9.
Sure.
Right? Within the scope, we don't need to go to the shareholders to have this approved, right? So that'd be another mechanism to manage this.
Again, it screams what you said to me at the beginning. I can now entirely see why you're saying to people, you need to sort these things out before they happen otherwise. In the last few minutes that we have, because you've been so kind in really packing this full of information for everyone, I want to give you the opportunity to double back on and echo some things that you said previously, which are, what are the elevator pitch things that you want people to know if they are already in receipt of these kind of awards? And what is the elevator pitch you want people to know if they think they might be about to receive these things for the first time? What do you wish everyone who came to you, Michael, knew before they came to you?
So what I would like them to know is that as an American, they need to consider 409 Cap A. So make sure that has been mentioned to your employer, and ideally you see it referenced in prospectuses for remuneration. If you see it referenced, then that means someone has considered it, which is the number one priority. The second thing is, if anyone mentions an election, that is a trigger point that you should consider the other countries. So they mention US election, look at this for a UK election. If it's a UK election, to consider a US election. And also, if you are getting a tax attractive award such that it does not have PAYE or indeed US tax at the requisite or typical transaction point, then you will also need special advice to see whether that works. So an incentive stock option is an approved stock option for US purposes that does not have a US tax charge on exercise. you need to consider, well, what's the UK tax treatment of that? And does that work? Because it may be that you don't want an incentive stock option. Maybe you want something different. And maybe you actually want the UK equivalent of a company share option plan. So, those are the things that I would say. And I would leave by also saying that approved UK schemes are not always bad.
Mm-hmm.
So I had a list here: share incentive plans, company share option plans, save as you earn plans, enterprise management incentives. And indeed, you might see certain growth share as well, which are sort of specialist arrangements that people put in place. Those actually can all be quite attractive for Americans in the UK if they've got sufficient foreign tax credits. But this Section 409 Cap A issue I've mentioned does have to be managed and overseen.
I was going to say to you something I often have to say to people at the end of these episodes, which is I say, do you think we sufficiently scared people? You offered just one slight silver lining, an uptick at the end there for things that mean that maybe things aren't as bleak as people first thought. Michael Lewis, partner in the US-UK cross-border tax services team at EY, thank you so much for joining me today.
And thanks for having me, Aidan.
Thank you for joining us today on this US-UK Tax Talk podcast, and thank you again for Michael for sharing all of his insights. It was really great to have him on the episode. A reminder that we are now recording our episodes on a monthly schedule, and our episodes drop on the first Wednesday of each month. Make sure you like and subscribe, and that way you won't miss an episode. Make sure also to leave a review or a 5-star or a thumbs up or something else, and that way our algorithm knows to promote the podcast more broadly. Finally, make sure to check out Collyer Bristow's YouTube channel, where you can find all our recent episodes in glorious video format. We'll see you next time.